Okay, hi everybody. We're just waiting for everyone to join. We'll begin shortly. Okay, thank you everyone for joining. Today's webinar is going to be very, very useful, very informative, and practical. So the topic is about using the right entity, choosing the right entity, and all about the versatility of the LLC for all kinds of businesses, and of course, real estate, which is what we do best. So thank you everybody for joining. I give very special thanks to the team at Fasten for agreeing to run this webinar and to give the material. Jacob Lerner, CPA, will be giving the class, teaching you everything you need to know. We have very nice slide decks that go through everything that's going to be covered or hopefully be covered in this presentation. Jacob said he's going to try to keep it to 30 minutes. I don't know if we'll be able to hold him to that. And if you have questions during the webinar, all you need to do is put them into the Q&A tab on the bottom. Everybody has the Q&A tab. Don't put it in the chat. You put it in the chat, it's not going to be seen, but if you put it in the Q&A tab, we'll try to get them. Jacob will try to get to them at the end of his presentation. So without further ado, yes, it's being recorded and we will send out the slides for those who request it. So without further ado, Jacob, take it away.
Thank you, Aaron, for that lovely introduction. And thank you to Riverside Filings for hosting this webinar. We're going to take a look at general entity choices. And as Aaron said, we're going to explore a little bit the versatility of the LLC. Before we go forward, I understand two things. Number one, the slide deck is going to have a lot more information than I'm going to cover. It's meant to be more of a resource for everybody, and Riverside will circulate that at the conclusion of the webinar. In addition, I do have Moshe Roth, the tax manager in our office, who's managing the Q&A feed. So if you do have any questions along the way, hopefully we won't even have to wait until the end. We'll have try to get your responses as quickly as we can. Keep in mind that this is a diverse crowd and there's a lot of different levels of knowledge over here with respect to different entities. The idea of this basically is to just give people a little bit more information, to be more armed, to be able to have more intelligent conversation with their tax professional, their accountant, or their lawyer, legal counsel when they're setting up a new business. With that, just wanted to give a quick introduction for our firm. Fasten is a full-service accounting, CPA, and tax advisory firm that's been founded about 8 years ago and has built this reputation of professionalism and passion to take care of its clients' needs. My name is Jacob Lerner, and I've been in practice since 2007. I've been in many different firms along the way, including the Big Four, but I've been here with Fasten for the past 4 years. With that, let's discuss objectives. We're going to go through a list of available entity choices that are out there, and we're going to discuss some general tax concepts and other legal concepts, maybe a little bit, that are pertinent to those entities. We'll then take a little bit of a closer look at an LLC and its versatility. The idea being all to help you choose which entity is best for you, but we're not going to make that choice for you. And you'll see as you're going through that, they'll have more questions than answers, but hopefully it'll give a little bit more information as knowledge is power. And finally, we're going to conclude with a listing of some of the frequently asked questions that Riverside itself gets, Riverside Filing gets when they have to form entities for their clients. So we'll take a look at some of those questions and try to give our thoughts about those questions. At this time, Moshe or Aaron, whoever it is going to launch. We have one or two quick polling questions just to get an idea of what the knowledge level is out there. Somebody please launch the polling question.
When I go to related orders, I press the link. Is that how you make the link file? Oh, sure. I have the file.
Not sure if everybody's able to see the polling questions.
Yeah, they're up. People are answering.
Okay.
Okay, so let me know when we can continue.
should be, looks like, yeah, looks like we have everybody responded, so. I'm going,
Okay, thank you. I guess I can tell you based on what I see with the open.
okay, just,
I see that for exception 3, we have a PR.
Okay, it looks like a lot of people like to file in Pennsylvania. Okay, so some people are looking forward for better air quality, not as many as they would have thought or expected. And I see a mix of participants that choose their home state versus Delaware, and a mix of people that use corporations versus LLCs for corporations. Okay, so perfect. We're going to get a little bit more into that, and hopefully we'll come away with a little bit more of an insight and understanding. We move along. So altogether, there are about 8, I've doled it down to 8 different business types, but there are also variations for professionals under both the corporate and LLC umbrella, namely the PLLC or the PC. So you can really spin this even more than 8. That being said, let's take a little bit of a dive into the different entities. So the sole proprietorship, that's where we start with. That's the most common business entity out there. And if you think about it, the reason why it's the most common business entity is because if I pay you money just to consult with me or do any service for me, that already is a sole proprietorship. It's the simplest business entity, but there is no liability protection. If it's operating business, you have to pay self-employment taxes on the business. If it's a real estate property that you own directly, it'll appear on your personal return on Schedule E. If you have a farm, it'll be on Schedule F, actually. There is no PTIC. That's the new buzzword this year. The pass-through entity tax, which is the SALT cap workaround. Again, a little bit beyond the scope of this presentation, what that is, but you're not going to get the PTIC deduction for your entity and be able to deduct the state taxes if you are using a sole proprietorship entity. So although it's the most common business entity in a certain sense, it may not be the best or the most tax efficient business entity. And finally, since a lot of us are in New York City, keep in mind that business operations for a sole proprietorship are subject to the quote unquote unincorporated business tax as opposed to the corporated business tax. UBT is the unincorporated business tax, it's 4%. If you're a corporation, then New York City will charge you 8.89%. Moving along to a general partnership, which is basically a sole proprietorship on steroids, because you have 2 people that join together to operate a business that is, as co-owners, that's going to be a general partnership. There's nothing that really has to be filed with the state. You do need a federal ID number. You're not going to have any liability protection. And the income and losses will be passed through to its partners. I'm sure a lot of you are familiar with Schedule K1. And each partner must pay the share of self-employment taxes on their distributive share of income of operating business income that passes through to them. After the general partnership, then we have another variation, which is a limited partnership, which is where you have a limited partner, where you have a partner that is taking a less active role in the business, more of an investor, and he wants some protection. You could have a limited partner, needs 1 general partner, 1 limited partner. Again, in general, with partnerships, there are always oral agreements. Written agreements aren't really required, but they're always a good idea. They always will document and show your relationship, both for your own relationship or internal service purposes, as well as to show the IRS the backup for whatever allocations you're doing, because you could have different economic relationships associated with how you're sharing different types of income. You're going to need a certificate of formation with the state. You will have limited liability for the limited partner. However, keep in mind that if the limited partner starts to take an active role in the business, he could become liable as a general partner. So keep in mind those unintended consequences of trying to take an active role in the business. In addition, limited partners do not pay self-employment tax on their share of the earnings to the extent that they're limited partners. Then we'll move on to a limited liability partnership, which is used by professionals to give several liability, meaning separate liability for professional acts of the different partners. You will need a statement of authority, and otherwise it would be very similar to a general partnership. There's another variation of a limited partnership, which is not available in all states, and that is the limited liability limited partnership, which is basically a general partnership that gives you limited liability even to the general partner. I don't think New York State has this option, but again, another business option that's out there. We then move on to the limited liability company, which is a more versatile form of business. You do need to file a certificate of organization with the state, and the owners of the company are known as members. If there's only one owner, then it will be a single member LLC, and a single member LLC will be disregarded for tax purposes, and the activity will be reported on the Schedule C of their personal tax return. So this will vary from a sole proprietorship in that there will be liability protection, whereas the sole proprietorship has no liability protection. Now that you have an entity that you're using to conduct your business, you're going to have that liability protection. The members or the member managers can bind the LLC for contracts and such like. And if there are multiple members, then by default the LLC will be taxed as a partnership. We will go into a little bit more detail later on how the limited liability company, the LLC, can be used in other manners as well. Then we have the corporate form of business, which comes in two flavors. By default, you have the C corporation form, which is an old form of business that was, that they came up with years ago. When corporate America first started. You're going to need to file an articles of incorporation, and you're going to you need to have bylaws. It needs to be managed by a board of directors. So the operational structure of a corporation is much more complex than that of an LLC. Authorized persons, officers can bind the corporation. You will get shareholder protection for acts of the corporation. And there is a corporate level tax. It's its own entity. It operates on its own. It pays its own taxes. It's an alter ego of its owners, and it will pay. The corporate tax rates are currently 21%. And any distributions that are made to the shareholders of the net profits after taxes will be subject to dividend tax if that money is taken out, is distributed, and that will be taxed at 23.8%. So effectively, you're going to have about a 40% tax rate if you're pulling money out of the corporation. However, keep in mind also losses stay in the corporation. It's its own entity, and it pays its own taxes and keeps its own losses. But there is no self-employment tax to the owners. The dividends to come out are subject to dividend tax, not self-employment tax. And liquidations may give rise to a tax liability. The other form of corporation is the S corporation, which is essentially a small business corporation. It's a C corporation that makes a special election to be treated as an S corporation by filing Form 2553. It may only have one class of stock. If it has more than one class of stock, it's going to be viewed by the IRS as a C corporation, and that could have unintended consequences. You have to be very careful about making sure that you have only one class of stock, and it can only have 100 shareholders, and not everybody is a valid shareholder of it. It needs to be individuals with some exceptions. The income and losses pass through to the shareholder, sort of like a partnership in this case. However, you need to keep in mind that it works on a pro rata basis based on share of stock ownership. And the same is true with distribution. So there's no special allocation. And this is what I was saying before. You need to make sure you have one class of stock. And if you're going to have different distributions not going pro rata or income and losses not going pro rata, the IRS views that as more than one class of stock. And that could be, therefore, it will blow the last S election, which could have unintended tax consequences. So now that we've laid out the different types of entities, let's take a look at what the objective is of your entity. You have to understand the objective to be able to determine how you want to, what entity you want to choose. So one question you would want to ask is it a low risk business? Because if it's a low risk business, you don't need as much of a robust type of liability protection. In addition, will you need additional investors? And what type of investors are your investors? Some investors don't want to have compliance associated with their investment, and therefore they like the C corporation, which acts as a blocker, and they'll just take the distributions out. Also, you don't need to give tax distributions to your owners if you're a pass-through entity, if you're not a pass-through entity. If you're a pass-through entity, then you need to give tax distributions to cover the tax liability associated with their share of income that's coming out to the owners if it's a pass-through. Another thought that would come to mind will be, will it be quickly generating net profits? Do you need to withdraw the money? That's something you want to keep in mind when you're considering what type of entity to choose. Will you have employees right away, and do you want to incentivize them? Do you need stock compensation? Is it also being used to implement estate planning objectives? That's another consideration, because step-ups of basis upon death will be different if it's stock versus property. And finally, rental real estate will generally use the LLC structure, as we'll see a little bit more why, but that's something that in practice that's the way it is. So let's go into a little bit of a deeper dive into the various different types of entities and one versus the other. So why would we want to choose an LLC over a C corporation? So an LLC is either a partnership or a single or disregarded for tax purposes by default. Why would you want to choose an LLC? Because you're going to have a single level of tax, and your losses are going to generally pass through to the members, which is very important for real estate. So now we're starting to understand a little bit more why we would want to choose an LLC. In addition, there are tax-free distributions of appreciated property out of the LLC, so it becomes quite versatile in LLC. There's also the basis step-ups that we discussed, whereas if it would be a C corporation, you're just going to step up the stock basis. You can't depreciate stock basis, so it's not so valuable to have a step up the stock basis as opposed to an LLC where you can step up the basis in the actual property held by the LLC. Furthermore, New York City taxes corporations, but there's no, but for non-corporations, there's no UBT or unincorporated business tax for real estate. So now, certainly we can understand in New York City why you want an LLC, and even not in New York City, having an LLC allows you to pass through losses for real estate and allows you to step up in basis to property and allows you tax-free distribution of appreciated property. Why would we want to choose a C corporation over an LLC? So one thought that comes to mind right away off the top is that some investors don't like LLCs. For example, non-for-profits. They won't have they want to be shielded from the UBIT, which is the unrelated business taxable income that they have to pay if there are unrelated businesses going on in the not-for-profit. And this is true from their investments as well, that they may have. In addition, foreign investors want to be shielded a little bit from U.S. compliance as well. So that could be another factor that needs to be kept in mind. LLCs also require tax distributions because of its nature that the income passes through to the owners. You need to cover that liability of that income if it's generating real positive income. You're also going to be able to avoid possible taxation in multiple states. What that means is that the C corporation will pay tax in the States, but the dividends are only taxable to the home state of the owner. And it does allow for a more versatile and robust equity compensation structure. Whereas LLCs, you have to draft difficult operating agreements that can be quite complex with respect to those allocations. And LLCs are also The C corporations are also the only form of business that's going to be able to claim the Section 1202 benefits, which is the qualified small business tax. Again, beyond the scope of this presentation, but the C corporation is your go-to for Section 1202. You also could avoid self-employment taxes by the C corporation, other than paying reasonable or compensation to the owners or the operating members of the organization. And the tax rates are quite low for C corporations. So to the extent that the company is leaving its earnings, it's retaining its earnings and growing its business in growth mode, a C corporation could be very attractive because you only pay the 21% tax. You're holding the earnings in, assuming your growth, and you don't have an issue with accumulated earnings tax. A C corporation could be something really that you may want to consider. What about an S corporation over an LLC? S corporations, the big one is the last bullet, that they save in the self-employment taxes as long as you're paying reasonable compensation. But there are other reasons as well, and that would be for tax-free reorganizations, assuming you know your target exit, your target buyer, and you could identify what type of entity they would like to buy. It does come up that there are instances where the S corporation would be an attractive type of organization of structure for your buyer. And they could also give some sort of traditional equity compensation structure, whereas LLCs do not have that. What about an LLC over an S corporation? So for an LLC over an S corporation, we have number one, no limitation on the types of owners. That's one attractive. They're both pass-through entities, but there's no limitation for an LLC on the types of owners, and it's much more flexible in terms of the allocations of tax attributes and distributions. Meaning, especially with respect to promotes and those items, which is the real estate world likes that a lot. You're going to want the LLC over the S corporation. So we're starting to really understand why the LLC is more attractive than the other forms of business. In addition, you're going to be able to get the basis step up. There's no corporate level tax, and the private equity buyers do, for the most part, they do like the LLC form a lot. That is very attractive as your exit strategy. And finally, you get debt basis in the LLC, which is another key reason why the LLC, yet another of the many myriad reasons why an LLC would be a very good form of business for real estate. What about why would we choose an S corporation over a C corporation? So an S corporation is a pass-through entity. You have a single level of tax that flows through to the owners, and the losses flow through to the owners. So that would be the reason to go for the S over the C. At least two reasons offhand that we could think of. What about the C corporation over the S corporation? So the C corporation does allow for convertible preferred stock. They have a more robust type of structure for stock ownership. They also don't give out K1, so your income is blocked. They protect your investors from compliance, as we mentioned earlier. There's also the protection for state filing to the owners who only get the dividends. And furthermore, only the C corporation can go public. And recall also that only the C corporation can get Section 1202 benefits. In the startup world, only C corporations are retaining their earnings to grow. So therefore, it wouldn't really practically, it wouldn't come up that you're going to get the double taxation. So that would be something that you want to keep in mind as a less of a factor when considering the C corporation. Let's take a little bit of a deeper dive now into the LLC. LLC gives robust liability protection. Certainly some states like Delaware has, again, this is more of a legal question, but Delaware does have statutes that give good protection for LLCs. You also get to control business affairs by the member managers. They retain their control, which is something that's very valuable to the owners. And you could use the LLC for different forms of business, as we will see in a moment. In addition, there is the single purpose entities that are used in commercial loans. LLCs tend to be the favored entity for that purpose. And it also allows for the special allocations that are so valuable for the real estate promoters or any type of business promoter. So LLCs are very flexible. LLCs by default are single member, are disregarded for tax purposes. They just give liability protection. Multi-members become partnerships. If there are two owners of an LLC, then it becomes a partnership, and it passes through, the income passes through with the special allocation. However, the LLC can change, can morph into a C corporation or an S corporation by election. For C corporation, it's Form 8832, and for the S corporation, it's Form 2553. So we're starting to see now why it is a very flexible form of business. Furthermore, and this is something that an attorney told me a couple of years ago when I was in Ernst & Young, fund managers like to use the C corporation, the LLC, as a C corporation, electing a C corporation if they need to have a C corporation in their structure. The general traditional C corporation has its form of business that you have to have the board of directors with votes. It becomes much harder to control. Whereas the member manager LLC, where the member managers are the promoters, they have the LLC as a C corporation. They retain their vote and control of the LLC, and the investors will be the non-member managers who won't have any voting rights. So they are retaining their control. And then there is the legal aspect and liability protection that LLCs afford. In commercial loans, there's not to be confused with the special purpose entity, but there's a single purpose entity that would hold the asset. This is very typical in the real estate world, where you have one LLC that owns directly the property, and then there's a structure above it. The purpose of this is to isolate the financial risk for the lenders in case of default or bankruptcy. Obviously, you're going to want to consult with legal counsel about which state to form it in. Delaware is one state that seems to be very favored, but it doesn't really have to be Delaware. It could be the home state where the asset is located, or it could be your home state. Somewhat tax averse, more of a legal question. There is also where you have multiple tier. We have a second tier. Some lenders do also want a springing member, meaning they want to have a single purpose entity on the bottom of the structure holding the asset. And then they want a second level where you have at least two members. You have two owners, even if it's a 1% corporate owner, so that will give them the ability to make this entity become bankruptcy remote and give them their protection that they're looking for. And as an added benefit, you could take the PTET deduction if it's generating positive income. And you have an extra compliance layer so that it stays off the personal return if the asset is owned by one person, ultimately. Also, LLCs allow for special allocations, which is what makes it the most attractive. However, you do have to keep in mind that for the allocations to be respected, they need to have substantial economic effect, which means that there needs to be an economic reason other than tax savings for giving those allocations for it to be respected. That's beyond the scope of this presentation, but people do special allocations that have no economic effect, that only have a tax effect, and it's going to work as long as it's not called out by somebody that knows what they're doing on the IRS side. Okay, and finally, before we wrap this up, we're going to take a look at some of the FAQs that are addressed to Riverside. Number one, your typical question that comes to Riverside is, should we start as an LLC or an S corporation? Okay, so now we have a little bit more insight into that. It really depends what you're trying to do with your business. Are you operating, are you getting self-employment income or not? And what your exit is, what your exit target buyer is. You now know a little bit about the taxation of S corps versus LLCs. So that would give you some insight into that and depreciation and step-ups. What about the tax advantages of setting up multiple LLCs in different states owned by one holding company that's operating a business in multiple states? So that's somewhat of a liability legal question. It's a tax averse question, but keep in mind that if you do form multiple LLCs, each one in each state, you're going to need to register. You're not going to need to register as a foreign entity. Whereas if you have a Delaware entity, for example, you're going to form a Delaware entity for each state, and then you need to register in each state as a foreign entity. But again, consult with legal counsel to make sure that you're getting the protection that you need for your type of business. What about another question, which state to form the primary holding company? That's a question that comes up. So that's a tax averse question. You could use either Delaware or the state of the promoters. It doesn't really matter at that point. You're sort of aggregating investments together. What about another question that comes up? When purchasing real estate, is LLC the only choice? I think we could probably say that LLC is the only practical choice, given all the items that we discussed. Is there a difference between New York City and the rest of the country? Now, certainly in New York City, there is a very big difference because a corporation pays corporate taxes in New York City, whereas LLC for real estate will not pay any tax at all. So that's an 8.89% difference right there. Should one file the LLC in the state of their residence versus where their property is located? So again, this is more of a legal counsel because it really depends on the levels of protection and the nuances in liability protection that the states afford. From a tax perspective, there's no real difference, but you may have to file as a foreign LLC in the state where you're buying the property. Delaware seems to be favored, as I mentioned earlier, because of its established legal framework and asset protection and its modern statutes. I'm not sure if we have time for any further questions, but at this point, I wanted to just say thank you for listening, and once again, thank you Riverside for hosting this forum. And I wanted to turn it over now to Ellie Teitelbaum. Unless we have time for questions, you guys could chime in and let me know.
Hi, thank you, Yaakov. I guess I'll give a chance. Are there any questions in the Q&A, or they're all answered? I see already. Okay, so if there are no questions, if nobody wants to type in quickly while I'm finishing this up, I wanted to just say thank you everyone for joining. Thank you, Yaakov, for the presentation. You could reach out to Yaakov or myself if you have any questions on anything that was discussed. Someone just asked if it's being recorded. The answer is yes, it is being recorded. And as Yaakov mentioned earlier, we're going to send out the slides. If you want a recording, you can ask for it as well. We'll try to get it to you. I would just like to finish off by notifying you of a free service here at Riverside Filings. We're notifying our clients and putting it out there, and people are really taking advantage. Basically, we're offering a free service, a free status check to check the status of your entity, to run an audit on your portfolio of entities if you have more than one, and we'll let you know if they're in good standing, if they're compliant, when your next reports are due, and we want to make sure that you're not paying fees or have any entities that you don't need to keep up that you're still paying registered agent services on or state fees on. So we're offering it as a free service to do that audit for you. Someone just asked how would you reach out to us? So I guess we'll put like you said, we'll send an email follow-up to everyone that signed up with the slides, and you'll have both Yaakov and my email attached to it. And again, thank you all for joining, and we hope you enjoyed.